Markets and take a look at futures are up and running and rolling at this early juncture Monday in Asia. They're handicapping what looks like a down start, maybe a bit of some give back when Wall Street gets back up and running for a fresh trading week tonight Asia time. But remember, it's going to be a holiday shortened one and a Thanksgiving on Thursday, of course. Markets in this part of the world are shaping up like this. Change the charts. Here we go. We are off to, wow. The handover from Wall Street, strong gains there, and we're seeing some very good follow through so far in Asia. Nikkei 225 leading the way, up 1.25%. The Korean market, the Kospi in Seoul is up 0.8. Sydney is up 0.7%. Let's bring in our guest host for the hour. Francis Tan is Chief Strategist Asia at Indo-Suez Wealth Management, joining Sri and I live around the desk here at the SGX. Francis, good morning. Good morning. Great to see you and welcome back. So, this week for markets, right, we're watching Trump's picks, how they fill out, of course. The other thing we're watching is what happens with the PCE. Which do you have your eye more closely on?
Well, if we look at the latest inflationary trend in the U.S., I guess it's a little bit more on the stubborn side. Things are not coming down as much as what the world has been thinking. Especially right now, if we look at inflation expectations right now, there was also released quite recently. Although the one-year expectations is still quite okay, around 2.6%. But Americans' view of the next 5 years is going to be a little bit more inflationary, above 3%. So what that says is that I believe with now expectations of a couple of things. Number one, Trump coming in as well. Number two, the potential tariffs that's going to be levied on imports from China. I think these are going to be implying a lot of inflationary pressures into the U.S. So core PCE, while the economic condition right now in the U.S. is more benign than we have seen 2 years ago, of course, but I think going forward with the implied tariffs coming in and with potential corporate tax cuts that will stimulate aggregate demand in the entire U.S. economy, that could prove to be a little bit more inflationary in 2025.
What does it mean for the Fed, though, in a couple of weeks' time, the last FOMC of this year? It's a coin toss, right? Are they going to cut or not? What do you think?
Now, this is, of course, recall in September, wow, the Fed 50 or 25, remember? Yeah. Now, December, cut or no cut. From the Indo-Suez point of view, we believe that there should still be a 25 basis point cut, irrespective of now we know who's going to be the new president. However, what matters right now should be 2025. Will there continue to be potential 4 rate cuts or not?
What do you think?
The market seems to be thinking that there shouldn't be such a 4 rate cuts coming up in 2025. Indo-Suez House View is still maintaining a 4 rate cuts for 2025 really? Right now. Of course, it can be anything in between, right? So, I mean, markets do change their views quite constantly. I mean, if you look at the implied futures, usually it changes in fact, on a day-to-day basis. So this is something that we need to watch out for.
Francis, does all of this add up to meaningfully higher yields, meaningfully higher dollar? And let's look at the rates market here. Is there a risk that the 10-year yield retests 5%, possibly even higher? And how much of a headwind then is that going to be for us in Asia?
Certainly there is some risk of the 10-year moving towards the 5%. In fact, our investment bank recently has issued a report saying that it could potentially move towards the 5% mark. Now, recall my earlier interview with you, I was saying that 4.5% could be on a risky zone, but now seems like market has been pricing in an even higher yield. So for now, I don't think that we should be anything too surprised if yields can move substantially above the 4.5% mark. I would say 5% is stretched. But anything towards the 4.5 seems to be, within the radar quite quickly.
You know, to be honest and also to be fair, right, honestly, we're all sort of sitting here in the dark. We're guessing, right, just how aggressive are tariffs going to be, how inflationary are the other policies going to be. But, you know, Scott Bessent, the incoming Treasury Secretary, or the nominee, rather, and we'll see whether it gets through the Senate or not, was talking to our colleagues stateside, I think the day after the elections. I want to play you a soundbite, Francis, of what he had to say, and then we'll continue talking. Take a listen.
You know, we're going to see deregulation, which is disinflationary. We are going to see President Trump has said he wants to get energy prices down, disinflationary, and then tariffs are a one-time price adjustment. The Federal Reserve, in their Teal book in the summer of 2017, said that the Fed should look through tariffs And my view, and I don't have a say now yet, or maybe ever, but is that I would recommend that tariffs be layered in gradually, which would the price adjustment would be over a period of time. But I think if you take that price adjustment coupled with all the other disinflationary things President Trump is talking about, that we're going to be at or below the 2% inflation target again.
At or below the 2% inflation target. Tariffs should be gradually phased in, so I think that's something the market is liking the sound of. And most importantly, the offset to any inflationary pressures is deregulation broadly, but specifically also deregulation of the energy sector. Pump, baby, pump, bring the price of oil down.
That's right.
Does that make sense to you, and is it going to work?
Well, certainly there are two schools of thought right now. There are factors driving the disinflationary forces. In fact, the US is in the state of the business cycle that has to be a little bit more disinflationary than 2 years ago, for instance. But the other school of thought is that some of these measures will be inflationary. Now, think of the knock-on effect. If there is deregulation, if prices has been coming down, but the deregulation and the corporate tax cuts drives, like what I mentioned just now, the aggregate demand growth. So Americans feel a positive wealth effect. They start going in there, they increase the consumer demand, PCE goes up, things will go up as well. So it's very hard, of course, in any economic model to ascertain whether the disinflationary forces will be stronger than the inflationary ones. So we have to say that the cup is half full, half empty. It really is anyone's guess. Yeah.
Wow.
Francis, who then is, I'm looking for the analogy, the cleanest shirt in the closet at the moment with regards to how we need to allocate towards the APAC region as we head into 2025, given the balance of risks, given all this uncertainty with the Trump economic plan? And is it overly simplistic to start scaling back perhaps on some of the trade-dependent economies in North Asia and perhaps increasing allocation towards those that have a more domestic focus vis-a-vis India, notwithstanding the Adani issues, and that's another story, India and Indonesia?
Okay. Well, I will say that it's on two folds. Number one, indeed, you're right, Sri. We should look at the countries that has a higher domestic consumption as a percentage of the GDP, those that are less reliant on export of goods, not services, goods. Because at the end of the day, Trump's tariff is on goods, not on services. Services seems to be off the radar. But indeed, guess what? In many economies today in the world, a lot of them are doing imports and export of services, and that's increasing as a share of GDP, more for the developed market. So you're right. On one hand, we should look at economies that are more reliant on domestic consumption as a percentage of their GDP. But on the other hand, China has evolved over the last 8 years, in fact, since the last Trump administration, since the last of what we heard, tariffs. China has grown a lot more, of course, they call it the dual circulation. China has grown a lot more domestic-centric as well. And China, its export sector has been shifting to the other countries. We have seen how China's export to the US has been slowing down over the last couple of years, but its exports to the other countries, including us in ASEAN or the other parts of the world, has been rising. So yes, on one hand, we look at domestic consumption, but on the other hand, do not ignore those that are trade dependent, because now they are receiving new flows. Yeah, I mean, constantly talking about factories moving out from China, moving into ASEAN. When you move out to ASEAN, there's production fragmentation, and goods will need to move into ASEAN as well. So I would say that if you want to look at the trade sector, look at ASEAN.
Undeniably, intra-ASEAN trade has just flourished.
Yes.
But when you look at what's happening in Europe, and when you consider that this remains a major destination for Chinese goods, how concerned are you about the external growth picture for China?
For China, you see, one of the things is that people tend to compare China and Europe as well. Europe has been not doing that well in terms of exports, mainly because of two fronts. Number one, consumption goods. Chinese have been slowing down their consumption good imports from Europe, mainly in the luxury sector. So that's one. Number two, capital goods. Germany, for instance, used to be exporting lots of capital goods into China because China needs capital goods to produce or to process the intermediate goods and to produce the consumer goods to be sent out to the rest of the world. Guess what? Over the last couple of years, China has gained productivity and strength in even building capital goods themselves. So all your heavy machinery, China can do it onshore. So these are the things that we are seeing evolving right now.
Diversifying and de-risking. Francis, we'll park it there for now. Get back to you later on in the programme. In the meantime, we'll take a quick break. Back in 2 minutes.